The stock market is declining, and investing in real estate is becoming more and more interesting again. Since mid-2024, I have been indicating that the stock market, particularly in America, is overheated. And for example, real estate funds have become very attractive, especially in relation to the S&P 500. I have also indicated that real estate funds are likely to outperform, meaning they can achieve higher returns and actually have a relatively lower risk profile due to lower valuations and a recurring dividend. These real estate funds, we have significantly declined due to, of course, rising interest rates, which heavily impact real estate funds, their profitability, and such matters. Now that the stock market is declining, these real estate funds are, of course, not entirely immune either. If the market falls and there is a crash, then everyone will exit the market. That means these real estate funds, which have actually risen quite a bit in the meantime, are now starting to decline again. And I think they will again provide nice new entry opportunities. So, new round, new opportunities. Here in this video, 5 real estate stocks, which I think are interesting because we have selected them based on relatively attractive valuation, large size matters, and profitability. That means high profitability and especially a lot of cash flow generation. Why is the latter important? Because in times of poor economic conditions, it is precisely the larger companies that generate a lot of cash flow here that can benefit from it, because they simply buy better properties in this case. Let's take a look at these real estate funds, and also known as REITs. And let me know what your findings are about these REITs. Since the summer of 2024, I myself have started buying some real estate funds, which actually doesn't quite fit within my strategy of investing and growth stocks. Only they looked quite attractive at the time. Still, my total return to date is 0.88%, so rounded up 1%. However, of course, I do receive dividends. I have set up automatic dividend reinvestment so that the dividends are added to these holdings. And of course, it's a long-term game you're playing here. First of all, I just show what I'm doing. So I have shares in MAA and NNN, Realty Income with the ticker O, and Vici Properties. All 4 are covered. Plus, lastly, another real estate fund that might be interesting. It caught my attention after a lot of research. I haven't bought it myself, but it might be worth further investigation. First of all, you still see a cash position of 55% here. Recently, I made a new monthly update of my investment portfolio. That is Maxim, which was Interactive Brokers, and also DeGiro. I now essentially have 3 accounts. What we see here is the business investment portfolio at Maxim. I have a private account at Maxim and a private investment account at DeGiro. A major shift from DeGiro to Maxim because Maxim is simply cheaper, especially for dollar stocks. That is very much a lot of money, especially if you have more money to invest. And I personally invest quite a lot in America. But I have reduced many positions because of everything that was coming. So far, it has turned out well. So I am grateful and happy for that. Hopefully, you have been able to benefit from it as well. But we will see what it will do in the long term. We are going to start with Vision Properties. By the way, if you also want to switch to Maxim, we have arranged a €100 cashback for all our followers and customers from happy investors, and you can find that link at the bottom of the video. Click there, and you don't need to create an account. But if you want to consider it, you will get €100 anyway. Discount or free transaction costs. That's how you should actually see it. That's what the cashback means. Properties, I think, is very interesting. Let's first take a look at a piece of the valuation from, for example, Motley or Morningstar. I was confused with Motley Fools, Morningstar, and that's an advantage of Maxim. It works on the platform of Interactive Brokers. Interactive Brokers is super large. That's where I first started with my business portfolio. However, switching to the Dutch variant is also more convenient in terms of customer service. And one of the tools they offer, which I find very interesting and useful, is an insight from Morningstar. You shouldn't see it as gospel, but more as inspiration. One of the things they do, for example, is provide a fair value estimate, or the intrinsic value. Morningstar gives Vici Properties a 5-star rating. We see this in all the screenings we use and that I show in this video. Many analysts are also enthusiastic about Vici Properties. What do they do? In a nutshell, they offer long-term lease contracts, primarily in gaming and leisure, and especially large casino properties, for example. Well, let's take a look. Due to all the rate hikes, it could be that the economy might enter a recession. And of course, inflation is somewhat on the higher side. People are more cautious with spending money. And naturally, one of the first things you would hopefully give up is gambling. So I'm not entirely convinced about how resilient VT properties will be in the coming months. But that is, I think, a good opportunity to take advantage of because the stock is already relatively cheap, high dividend, and with further market declines, it will only become cheaper and cheaper. Therefore, very interesting. And I also think reinvesting dividends is, I think, useful for this stock. The fair value SMA is still well above the current price, so it already means that Morningstar thinks the stock is undervalued. The further that price drops, the greater the margin of safety. But you will, of course, also need to do your own intrinsic value calculation. Have to do. Moreover, it also depends on the time horizon you use in your discounted cash flow calculation. We see historical valuation has been below both the fair value and the normal multiple for a while. That is the blue line we see. If we look at a bit of forecasting, which we should always take with a grain of salt, then the EPS estimates, in this case, AFO estimates, a more accurate term for real estate funds, from analysts are actually not exaggeratedly high, around 3%. Only the current price for waste is already somewhat on the lower side for Visi properties. It was, even around 12. And if something is cheap and it continues to grow, then it is naturally very interesting. So that means a relatively lower risk profile, not an enormous price potential. But in current times, it might still be attractive enough for dividend investors. And I assume that if you are a risk-taking good investor, like me, you find this less interesting. But sometimes you also have to fluctuate a bit in your strategy over time due to market conditions. Based on that normal multiple, which is around 16 based on the past 5 years, or 15.6. Based on the next 10 years, we can achieve a certain return. And that return, depending on the multiple we use, can be more than 10% on average per year. And as I've been indicating for a while, we have real estate funds and REITs, so this kind of similar profile. And is that simply more interesting than the S&P 5 trade, which just has a very high valuation? Well, what I said has come true, fortunately for myself, but also fortunately for the people who followed. And of course, we have to make our own choices because we never give personally advice. You know that by now. Hopefully, we have been able to benefit from that. Investors also give a 5-star rating to Vision Properties, pointing out some good things and some weaknesses. As with everything, you can pause the video if you want to read all of this, because the videos are getting very long. They are already long. Let's look at a piece of valuation. Everywhere we see that the factor analysis indicates a strong buy, and that's because the valuation is relatively okay. And this is about relative comparison. While the growth and especially the profitability are excellent, momentum is also good, and revisions mean that they expect the fund, in this case, to earn more money in the future, which is positive. But we mainly see that it is somewhat more desirable that you have a relatively good valuation with relatively strong profitability. Because if we generate a lot of cash flow and the economy turns bad over time, then companies with high profits can benefit greatly from that. The dividend yield is very attractive, and the price for waste is indeed around 13.4. It will start at 13.1 for next year. I do wonder what. The impact is therefore of tariffs, increases and such matters on the consumer contract. Don't forget they are in America. I think American citizens are quite heavily affected by all these price increases. I am not very convinced about the short term. But of course, this is about long-term thinking. And in that, I think Fizzy Properties is well positioned within their niche, which has actually become a large market. Good figures look very good, as you can see. But of course, we will have to see, or see how that is in the future. What we do know, at least, is what they are generating at the moment. That is a fairly large cash flow of about 2.3 billion. That also looks good. If we look at Zexrank, it currently gives a buy rating. Their price target is about $34. So slightly lower than Morningstar's fair value estimate, but that makes sense. Morningstar looks more at the long term, while a Zexrank, those analysts focus more on the short term regarding EPS development. What does all this mean in the very short term? I think Vision Properties is interesting for dividend investors. What I think doesn't really matter much, but what I do is, at least for myself, buy properties. In my Maxim portfolio, I have a slightly larger holding in it than in the other real estate funds. And I'm curious if it drops again, Vision Properties to a level of 27, then I think it's a good time to buy more. Not to jump in as massively, because it can always happen that if fear and panic hit the market, it continues to decline. Next price ranges could be 25.70. I don't know, it's all purely looking at charts. I think Vision Properties is already interesting enough to invest in now, or at least reinvest your dividend. And I just think it will rise a bit due to recent developments. And if you have a little patience, a price level around 27 could be a nice first entry point. The real estate fund Mid-America Apartment. With the ticker MAA, I have it in my own portfolio. And I find this an interesting real estate fund. I also think it's relevant just for the long term. They invest in apartments in America. And yes, of course, it will have an impact if there is an economic recession and such. Only I think, for example, a company like Visi Properties, which we talked about earlier, will, I think, be hit harder than, for example, a Mid-America Apartment. Of course, certainty is never the answer. Only we will see that Mid-America Apartment has a less interesting profile than VC Properties based on valuations. Morningstar gives it 3 stars with a fair value estimate of $160. Analysts on Wall Street think the price is slightly higher, namely an upside potential of 10%, with an average price target of 170. Thus, I think that given the situation, Mid-America could drop significantly. I will explain it to you in a moment. Why? First, let's look at historical valuations. What you ideally want to see is, of course, buying after significant drops, where the price actually just touches the fair valuation or is below it. Preferably even lower, of course. That doesn't happen very often, as you can see, even when we zoom in a bit more. Second time frame, it has actually only happened twice during the coronavirus crisis and the last dip in 2023. Well, if things go a bit in our favor, and we are lucky with patience, I think the stock might drop to the same level as in 2023, and that you can buy at a price that is below 15. We need some patience for that. I'm not buying more myself either, but I had already taken an initial position. And yes, nice. And I just let the dividend reinvest and, well, continue enjoying life in the world. That is, of course, just more important. Looking at the analysts' estimation, they think MMA will have a less good year in 2025, but can realize growth again afterward. We see a price reduction of 21 based on a 5-year average. I think that's way too high. Even a 20-year average is still 8.5. Personally, I would actually want to maintain a lower price reduction, because if you assume that 8.5 and these growth figures are or are not realized, then you have an average growth of 5% per year. That's not very high, of which a part is actually also a dividend. So yes, that's limited growth. If you assume a slightly lower multiple, for example, 15, then you're looking at a price of minus 2.3% on average per year. So that's bad. And then there's also 3 years of inflation on top of that. So that's not good. Why would I personally wait for the stock with a milk apartment as a real estate fund? If it drops to a price to earnings ratio of 15, I think it becomes interesting to start buying. We need some patience for that. For example, on Market Screener, we see that investors give it a 3.5 star rating. That's not very high. They also indicate that the growth prospects might be less interesting. Let's look at the valuation. Then we also see here that, for example, the price is still relatively high at the moment. So 19 is already on the high side, but also compared to the sector median. Total debt to capital is quite okay in itself. Looking at other factors, we see market cap and total debt. Not much special to report. Of course, they have debts as a real estate fund, which is logical. The dividend growth rate is interesting based on 5 years, 8.8%. That has been the case for 14 consecutive years, but that is to be expected if you are a real estate fund. So that's not very shocking. But other figures regarding growth don't look very interesting. Personally, I just think, yes, they invest in apartments. That is a continuous process that you keep repeating. So for the very long term, it will turn out well. What you mainly want to see then is, what is the return on equity? Well, the return on equity is about 8.7%, and that is significantly higher than the sector median. And that is interesting. This was also the reason for me to take an initial position in Mid-America Apartment based on that return on equity. And of course, you hope that it remains as high as possible. They also generate quite a lot of cash, or something like 1.5%, 1 billion off the top of my head. So they keep going strong, of course. Zex rank indicates a hold rating. The price chart from Zex rank in the short term 6 to 12 months is indeed higher than the current price. This is somewhat in line with other analysts. More interesting to see is that the price is still below the EPS development. And of course, we hope that the EPS doesn't drop too much in the short term. Because yes, if we start making less profit, then they will, of course, drop very hard in the short term. I also think that given the whole situation, that it might drop to a price of about 125, or if we're lucky, even to 117. That is quite a serious drop, compared to the last peak, so to speak. That means about minus 30%. The fund has already recently dropped a lot, almost 8%. I think we need to be patient here. And then we can also, if the stock drops to a price level around 2023, then you can buy it again. So below a price of 15, and that is exactly what we want. That is also somewhat the same price level as when it had just recovered from the Corona crisis. But please, especially look at the fundamental valuation, because that is what is important. So Hilti Income with the ticker O is, of course, very well known as the Motley Dividend Company, and we don't need to say much about the business model. Then let's just go and look at the statistics at this moment. And of course, keep in mind, statistics mean that you still need to do your own fundamental research, but it is simply one of the largest laundry funds. Perhaps that makes growth somewhat less attractive. Only Realty Income is currently operating at a relatively attractive valuation level. At least that is my opinion. Morningstar indicates a fair value estimate of $75. It also gives a 5-star rating, and the current price is, yes, of course, below that. Look at other analysts. They expect a slightly more modest upside potential in the short term, namely 0.5%. Look at the historical valuation of this company. Then we see that actually, after a recent decline, that the price is below the fair value. That is the price increase. A drop of 15. We see that this hasn't happened very often in the past. Also, if we zoom in a bit, we see some more current figures. So it's just below. So yes, you could say maybe not a lot of margin of safety. The normal price drop over the past 5 years is around 17. Let's take it a bit lower. For example, 15.8 or 14. And if we then take a piece of forecasting in relation to the growth figures we see below, I should actually say the growth estimates, then it could potentially achieve an average return of about 15% per year. So this is very interesting, just like Vision Properties. Both are more interesting than Mid-America Apartment, but the latter might surprise because they may have more growth potential. The analyst from Marker Screen gives it a 4.5-star rating. The dividend yield is currently very high for Realty Income. Almost 6% is estimated for next year. And the year after that, even 6% is naturally related to the recent price drops. And the valuation is not super high. We have already seen that just now. And we see that reflected here as well. Prices folding around 13. It is not extremely high. Surprisingly, Realty Income achieves quite interesting growth figures. You might not expect that because the fund is somewhat larger. It might grow less quickly than smaller funds. But still, they are doing very well. What actually disappoints me for the long term is that they generate a relatively low return on equity. About 2.3% is not super high. Other profitability figures are good, though. Here you see the EBITDA margin of 90%. 90%? Yes. That is, of course, something accounting related. The cash flow they generate is quite interesting. 3.5 billion per year. Hopefully that will increase for this fund. You can do a lot with that, of course, especially if other funds start to panic. And that might be an interesting growth strategy for this fund. Let's look at the dividend. Well, yes, the company has been paying dividends for 27 consecutive years. Dividend growth is somewhat less interesting. Interrupted, and they pay out dividends monthly. So that can, of course, be very interesting for some investors. The Zacks rank indicates a hold rating. Their price target is $62 in line with others. But we see that the price is significantly below the EPS line. This is also what Morningstar indicates. They expect that the intrinsic value is much higher than the current price. So I think that Realty Income is very interesting to buy around this level. But if we perhaps have some patience, then we see that around a price level of 51, it's a nice buying opportunity. And that's just a small drop of about 5%. Given the market development, there's a good chance it will still drop by 5%. If we're lucky, it will drop much further. For example, to 48%. That's about still like that, minus 11%. And then it might indeed be around 48%. Maybe it will drop even further. No idea. But I think if you can start buying from a price level of 51%, realty income is interesting enough for the long term, in my opinion. Don't forget, it pays out quite a high dividend. Let's say it's about 5% per year. So it's probably higher. And of course, you just want to automatically reinvest that. There might be less favorable times ahead. Then it will also generate less profit. Makes sense. Less growth as well. The advantage then is that you have a relatively high dividend. Continuously reinvest. Possibly buy the dip. Often applying it for dollar costing averaging. In other words, lowering your average purchase price. Then maybe not much can go wrong in the very long term. The only downside is, of course, always companies with high debts. A lot of debt. So bankruptcy is naturally reached faster to achieve than a company that has high profit margins and zero debt. Always keep that in mind. Real estate funds and REITs I personally find interesting also because of the dividend growth. For 34 years in a row, or now 35 years in a row, they have increased their dividend. Currently, the dividend yield is around 5.6%. 0.6 or percent. Oh yes, 5.6%. And of course, in the long term, it is very interesting that you continue to receive your dividend. Reinvest. The Morningstar rating is 5 stars with a fair value estimate of $50. Other analysts think that the price potential in the short term is about 10%. Looking at the long-term history, NNN didn't stand out because it is below the price threshold of 15. So in other words, a slightly lower valuation. I wonder if it's entirely justified. You'd prefer to buy it when the price is below the intrinsic value. You can calculate that in several ways. Intrinsic value based on discounted cash flow. That is particularly what, for example, Morningstar does. But you also see it here based on EPS. Price to waste, or price to earnings. You can also kind of estimate an intrinsic value. And then mainly look at what the market has paid in recent years. Well, these Fastcraft charts work very well for companies with a long history that are relatively stable, so not for growth stocks, for example. The price for waste has sometimes risen above 20 in recent years. That has proven to be too high a price all those times. But when the price of waste falls, look, in 2018, it even dropped to 6.5. Very interesting. During the crisis, of course. However, if it falls below the prices of 15, historically, we see that it starts to become interesting. Well, that's not a 100% guarantee of profit. You know how it works in the world of investing. But in principle, if a fund like NN and Riot continues to exist, and what they do is long-term, offer lease contracts primarily to business, and especially to restaurant chains, I think that's a no-brainer for the very long term. Food, everyone needs to eat. If it just continues to exist, then it means that the price below 15 simply starts to become attractive. And at the moment, it's around 12. Then we also see that the upside potential can be interesting, even if minimal growth is expected. But growth is indeed expected. So this model naturally does not account for a sudden drop of 10 or 5%, because if that happens, that will eventually apply to all real estate funds and will naturally lower the entire market. But that's also the case for stocks. Purely based on this forecast, which we should not consider as truth, we see an average potential return of 15% in line with Hilti Income and Properties. The conclusion is actually, if we just look at the historical valuation, that both NNN rate and Hilti Income, as well as Vision Properties, are all below at least the price for waste of 15, which is somewhat normal and on average. And for example, the Mid-America apartment, also interesting indeed. And I have also taken a position myself, a smaller position. Only that one is above it. So actually, it's a kind of shortcut, that price for waste, but it's not 100% the truth. So always keep that in mind. Yes, always keep that in mind. Let's look at a piece of investors rating from Market Screener. They give 4.5 stars. The valuation is basically okay. Based on the factors they receive, it gets a buy rating, mainly because all the factors are somewhat balanced with each other. It gets an A+ on profitability. That is quite relative. But as I said at the beginning of the video introduction, we mainly look at real estate funds that have relatively strong profitability because they can benefit extra from an economic recession. That dividend yield has therefore increased to about, and swim, almost made 6% for next year. In 2 years, it will go to 6% if they continue with their dividend growth. They have been doing this for 34 consecutive years. So I am very curious about a 5-year reach. I am very curious if they will keep it up. Dividend growth over a 5-year period, the CAGR is 2.4%. So it's not extremely high growth. I think there are better dividend stocks to be found, of course, but all in all, not super bad. Valuation. We also have profitability twice today. Looks good. The cash flow generation is somewhat lower than other funds. It is also a slightly smaller fund. Return on equity is 9.3%, so that is, of course, a good signal. Are we looking at that dividend? Consistency, that is interesting. Both 34 consecutive dividends paid and dividend growth achieved. Zex Schengen indicates a hold rating. Again, the price matters here. It is below the EPS graph, as we have seen with other funds. I myself have taken positions in NNN REIT around 2024. That was actually the price level. We see due to the recent decline, first it rose quite a bit, but now back to that decline. So I'm actually at a limited profit, as I also showed at the beginning of the video. However, indeed, of course, the dividend is paid out, you reinvest that dividend. So that your position only gets bigger and bigger. And as a result, you naturally receive more and more dividends. That is, of course, the whole essence of dividend investing. What is interesting, again here, if it starts to decline, thank goodness, please let it drop to at least 38, but preferably 35. We are really lucky. I have set an alert for myself at 32. If the price drops to 32, then you could buy this fund at the same price level as in 2014. Now, 10 years later, it is, of course, a much larger, stronger fund. Very interesting. Hopefully, maybe it will be the case. And then we will just buy significantly more, if that is the case with everything, every month. And I also share updates weekly. If I buy or sell stocks, then I will try to share that immediately. You can follow along, but purely for inspiration and not at all dirty. The last real estate fund for this video is CareTrust REIT, which caught my attention from a screener. The ticker is CTRE, and as the name suggests, they are active in healthcare, for example, elder care. I don't find the fund particularly good, so I'll go through it quickly. And for me, it's also worthy of further investigation. There are a few things that stand out to me that I would like to share with you. The fair value with a margin of safety is $31. The current price is $28. Analysts also think the price tag is $31. That means an upside potential of 13%. Based on the historical valuation, we can really see that the current price relative to fair value is somewhat above the line, as we would like to see it. This also has to do with the forecasting. Analysts apparently expect significant growth from this fund, particularly in terms of profit growth, as we can see below on the screen. If that is realized, and the price to earnings ratio of 14.8 remains approximately the same, then you have an average return of about 7.6%. There are two risks in this. The first is that price to earnings ratio, a ratio of 14.8, whether it will be achieved or not. But a much more important risk is if that growth is not achieved. Then the stock will realize a much less attractive return, while other funds that we have seen earlier, physical properties, realty income, in my opinion, they have a safer profile and can potentially achieve even higher returns. So that's why I find it somewhat less interesting from a momentary perspective, but further investigation is needed. Where does that potential growth come from? And is that growth perhaps more than expected? Or, of course, the healthcare theme is very relevant. Let that be clear. Investors from Market Screener give it 4.5 stars. Valuation is not particularly attractive, as we have seen. What stands out, however, is that they have relatively low debt at the moment, and the cash position is, in relation to that debt, also somewhat stronger than other funds. The growth figures are interesting. At least that's what we think. Analysts, with the expected growth for next year at 10%, also EBITDA growth, everything is growing, is increasing. So I am very curious about what is going on here, so further investigation. And by that, I mean fundamental research is indeed necessary. Profitability seems to be good, but return on equity is not particularly high at 5.7%. Looking at the dividend yield at the moment, dividend around 4.5%. Next year, it is estimated at 4.8%. There is indeed dividend growth. and they have been paying dividends for quite a long time. Of course, since they have existed, the analyst report then indicates a hold rating. And if we look at the technical analysis, we see a significant price increase compared to the past years. It has even risen by about 60% based on apparently good figures. And now it is starting to decline a bit, but not much at all compared to the market. So honestly, I don't know what the right price point will be. Of course, based on technical analysis, you could say that this price level here is interesting. That is a price level of 19, but that does mean a drop of about 30%. For now, I am definitely sticking with the more well-known real estate funds that I have purchased myself and mentioned in this video. Thank you for watching. Let me know which real estate fund you find interesting. I want to check that out too. Thank you for that. And I would say keep your head cool. Let that guy reinvest and don't look too much at the market when it crashes significantly. When everything is stabilized again, then buy a lot for the long term.